I personally, last year, was about to get hit with a capital gains recapture bill and pay somewhere on the order of like $80,000 to $100,000 in taxes. And because of that write-off, I paid $0 in taxes for 2025.
Cost segregation, or segregating the cost that you paid for the property into different buckets, basically, showing that certain components of the property actually depreciate faster. The most successful person I know in real estate, it's a no-brainer to him. Everyone else, they have no idea what it is. So there's like this huge gap. Instead of 30,000 or 70,000, you can take 200,000, that full 20% of depreciation in the first year.
Is that like a far-fetched idea, or is that similar to what you've seen with a lot of clients? Welcome everyone to another episode of the Apogee Wealth Podcast. I'm really excited for our guest that we have today. He's been a long time friend of mine ever since I got into commercial real estate, going back several years ago. And because we talk about all things, growing your wealth, financial savviness on this podcast, this topic I think is of particular interest to listeners. And so really excited to welcome Yonah Weiss to the Apogee Wealth Podcast to talk about all things cost segregation today. Welcome, Yonah.
Thanks for having me, Jonathan. It's great to be here.
Awesome. Well, you and I have known each other a while, and had the privilege to be on your podcast sometime in the past. And you've brought a lot of benefit to our investors over the years, although they may not realize it. And so it's your day to shine. But before we get going into cost segregation and saving on taxes and stuff, you want to just give a brief overview, like who is Yonah and how did you get into the commercial real estate space?
Absolutely. So my background is actually in teaching. I was a teacher for about 15 years before getting into real estate, which is now a little over 10 years ago when I first kind of dunked my foot into the pool and was really getting, wanted to learn everything there was to know about real estate. So I started out doing some commercial mortgage brokering, doing hard money lending. I got my real estate, residential broker's license just to kind of, get my feet wet in that area, did a few fix and flips and really got, doing a lot of things, on the mortgage. I was still doing like the commercial mortgages on the side. And so I was really learning everything there was to know about underwriting, about cold calling, and about, just every single acronym there was to know in the commercial real estate space, which was a little overwhelming at first, I must say. But once you get used to it, it's opened up an incredible world to me. And so one of those things that opened up was just the networking, just the people that I was meeting. And through that, I ended up connecting with the people at Madison SPECS, which is the company I work at now. For the past 8 years, been the biggest national cost seg company. And at that time, I knew very little about taxes in general, right? Like most people, if it's taxes, my accountant takes care of that. Like I don't have to deal with that. But I knew almost nothing about cost segregation, which I learned very quickly that neither did anyone else, right? It was like this topic that nobody knew about. Literally, before I got started in it, I was curious, and it was a great company, had some good people, some mutual connections. And so I was comfortable doing that. But while I was interviewing, I reached out to, everyone that I knew basically who I'd met in the past 2 years doing commercial real estate. And I was like, hey, what do you know about this cost seg thing? 99% of the people said they have no idea what it was. So I'm talking to people who were in real estate and had no idea what it was. And then I came across I reached out and connected with, actually was having coffee with a mentor of mine, a guy, very successful real estate developer, doing in the business 30 years. And, he develops like class A logistic centers, like million square foot Amazon facilities, like that kind of stuff, like really high level guy. And I asked him about cost seg, and he's like, oh yeah. He's like, we use Madison for all our cost segs. It was like this light bulb moment went off. It's like, okay, the most successful person I know in real estate, it's a no-brainer to him. Everyone else, they have no idea what it is. So there's like this huge gap and like this knowledge gap. And that's where the light bulb of my teacher moment went. I was like, what? It's just education. Like people just don't know what it is. Is that it? And so I took it upon myself. I was like, okay, this is a great opportunity for me, which is what my focus has been for the past, like I said, 8 years or so, coming on podcasts like this, using social media, doing webinars, educating people about this topic. And ultimately, because we have the resources, we're the biggest national company, they're therefore helping, investors save at this point, billions of dollars.
That's awesome. And yeah, it's something that going into commercial real estate, I didn't know anything about. I was just fortunate enough to connect with you early on. So, we were able to get that opportunity right off the bat. And, for listeners that, you've listened to the first few minutes of this podcast and you're just like, hey, this doesn't all make sense. I can tell you, like, I personally last year was about to get hit with a capital gains recapture bill and pay somewhere on the order of like $80 to $100,000 in taxes for my 2025 taxes, right? And we had a project that we were looking to close, a multifamily apartment project, and we closed that deal on December 31st, 45 minutes before the wire cut off. We sent it over to Madison SPECS through Yonah to do a cost seg, which is what we're about to discuss. And because of that write off, I paid $0 in taxes for 2025. Like that is the power of what we're about to talk about. So you hear people on the news, they talk about these real estate investors that make, pretty good money and they pay little to no income taxes. This is the strategy right here. So Yonah, you have a listener on here and, they recognize real estate's, a powerful opportunity. Maybe they even know a little bit about depreciation, but have never heard of cost seg. How would you explain that to them?
Well, perfect. I mean, if someone knows a little bit about depreciation, they're already on, got the right, going down the right path. So let's back it up and let's understand depreciation. We'll understand cost seg. We'll break it down very simply. So
Cool.
depreciation is the name of a tax deduction. Okay, it doesn't actually mean that your property is going down in value. It's a borrowed term the IRS gives you when you buy a property. Okay, it's a whether it's commercial, residential, doesn't matter as long as it's not your primary residence. Any other type of property, you're able to claim this income tax deduction called depreciation. So it's basically taking the property value, subtracting a little bit for land, which doesn't depreciate, and then we break it down over a 27.5 year period. So it's a kind of an arbitrary number the IRS gave and said you can take like 2 or 3% of the property value as a deduction every single year, as if it were going down in value. Now, the great thing about this is, like I said, it's a borrowed term. It resets and starts over every time the property transfers ownership, which means
Mm,
it has nothing to do with the actual intrinsic value of the property. It's totally subjective to the owner and based on the purchase price that they paid. So again, you can take this little deduction every year, 27.5 years, again, a little bit every single year. Or what we can do is this, what I call advanced depreciation. Okay, it's basically breaking down the property into its components through an engineering study. This is what cost segregation is. And take the name, right? It's a weird name, but it means cost segregation. We're segregating the cost that you paid for the property into
mm,
different buckets, basically, showing that certain components of the property actually depreciate faster, which means you can have, 20% of the property value that depreciates on a 5 year schedule as opposed to 27 and a half, and then take those deductions at that faster rate. So let's back up a second and just kind of understand that concept. It's like you have this pool of potential deductions that you may never take, right? You're taking a little bit every single year, but you have an opportunity to pull forward from that pool of deductions and get a lump sum in the first year or a lump sum in the first few, 5 years or so. And so what we're doing is, again, it's like a cash flow mechanism. Like you said, you have these potential deductions just sitting there waiting to be used, and you take this property, you do this cost seg study, and you're able to pull those deductions forward and basically borrow from yourself essentially. That again, you may never even take those deductions later on. So it's really the best of both worlds.
yeah. No, and it's you need an expert like Madison Specs to know how to break down the property and do this study. And if you can see one of these reports, they're probably what 50, 70 pages long. They're very extensive. And so there's a lot of math that goes into it. But you take something, for example, like the roof on the property, right? And I think that's maybe 15-year depreciation schedule or Correct me if I'm wrong. So we don't have to wait 27 and a half years to write the whole thing off. We can do it in 15, or we take appliances that might be like a 5 year schedule, and then
Right.
we write those off in 5 years. And so basically, it's just instead of just considering that the property is all one schedule, by breaking it
Right.
into components, we can put each thing on its own schedule, and then as a whole, you have more write-offs up front. But
Exactly.
then something really great happened in 2017, and then again here this past year. Maybe you want to kind of fill us in a little bit on that too.
Absolutely. We'll talk about bonus depreciation, but I want to reiterate, what you were talking about there is these different, but like we talked about buckets. We're saying
Mm.
we're going to put things on a 5 year or 15-year schedule as opposed to that longer 27 and a half. I should mention also commercial properties besides multifamilies on a 39-year schedule, so it's even more advantageous. Um, so the structure of the property is really the only thing that goes into that 27 and a half year bucket, which is usually the
Mm.
majority of the value of any property. There are certain exceptions to that rule, like RV parks or mobile home parks, which there's very little structure involved. But most properties, multifamily specifically, you're looking at 70 to 80% of the value of the property is going to be in the structure. So the structure actually does include the roof. Unfortunately, roof is on that 27 and a half year. The
Oh, so
walls,
I'm wrong.
foundation, doors, windows. That's right, infrastructure. But there's a lot of things. Like I said, 20 to 30% of the property value is going to be in those 5 or 15 year. So those two buckets,
Mm.
we talk about 5 and 15. 5 year property includes anything that is inside that's non-essential to the structure. So that can include furniture, fixtures, appliances, equipment, even stuff like carpeting or wall coverings, countertops, cabinets, window treatments, you name it, all kinds of stuff. And then outside, what we have is land improvements. This can include landscaping, pavement, concrete, like you have a parking lot, all the asphalt and pavement there, bollards, etc., fencing, stormwater drain systems, all kinds of stuff that's outside, that's on top of the land, that's considered land improvements. And again, we're not considering this as if you're actually doing any improvements per se. We can get to that a little bit later, but you just buy the property as is, and we're breaking down those components. And it used to be called component depreciation, which makes a lot more sense. But once we do this cost sake study and identify those different components that depreciate on that 5 or 15, those faster schedule, well, came along this law back in 2017 called 100% bonus depreciation. And what that said
Mm.
is once you've done a cost sake study, you now have the option to take those 5 and 15-year deductions in the first year, all of it up at once. So that's crazy because what that did was basically gave like a huge supercharge boost to cost seg. Instead of taking, let's say, 20% of your property value over a 5 year period, we're saying we take that whole 20% in the first year. Okay, so
Mm.
just to give a quick example of what that means in dollars, let's say you buy $1 million property and not doing cost seg, you would have about a $30,000 deduction every single year. That's just taking the value, subtracting land, dividing by 27 and a half. Again, simple math, 30,000, I'm rounding up, but again, we're just simple numbers, $30,000 deduction every single year. Well, let's say you took 20% of that property and you're taking over a 5 year period. That means $200,000, right? That we're now taking over that 5 year period. That's an extra $40,000. So I've more than doubled my deduction during those first 5 years. So cost seg we can see already is very powerful. Comes along bonus depreciation and said, hey, wait, instead of 30,000 or 70,000, you can take 200,000, that full 20% of depreciation in the first year. So that's where you get these huge values. And again, I'm using round numbers. This is just a random example, but you get the point. It's this huge supercharge to your tax deductions. And that's what 100% bonus depreciation was. It actually, when that law came about, it had a phase out period, which means if you bought a property in 2017, 18, 19, 20, 21, or 22, that was 100%. In 23, went down to 80%, 24 down to 60%, and then in 2025 went down to 40%. Thankfully, Trump passed the One Big Beautiful Bill in July of last year, actually about a year ago. And what that did in 2025 is said that now going on permanently, 100% bonus depreciation was reinstituted, and it's going to be going forward. So now, thankfully, we can use 100% bonus depreciation again, and very powerful tax strategy.
Absolutely. And so obviously for the listeners, or maybe not obviously, Yona and myself, we're not your CPA, your tax consultant. So you definitely need to take the educational information you're learning here and to your tax professional to see how it applies to your situation. But just kind of high level hypothetical. You have someone who they go invest in this $1 million property, right? And they get a $200,000 write off. How does that help them, right? Where can they generally use that or not use that? And because I think of a lot of our limited partners are like, hey, this write off's great, but like
Right.
how is it going to benefit me when it comes tax time?
Yeah, this is probably the biggest question that people gloss over. And it's probably the most important question because you're absolutely right, Jonathan. Tax deductions are great, but not everyone can use them equally or in the same way. And that's where this thing called real estate professional status comes into play. And what that does is, typically speaking, depreciation and cost seg, bonus depreciation, it's considered a passive deduction. What that means is you can only use that to offset your passive income. Passive income is real estate related income. Okay, your Schedule E on your tax return is rental property income. And so if you have investments in real estate, any of that income is treated passively. The depreciation can be used to offset or lower that income tax liability. However, it cannot be used, depreciation cannot be used to offset your active or your W-2 income. Okay, that is the biggest misnomer, I think, around cost seg, where people out there are saying, oh yeah, do a cost seg and then pay no taxes no matter what. If you're a W-2, unfortunately, that's not the case. Unless you or your spouse, only one of you needs this designation, are classified as what's called a real estate professional. Now, real estate professional status is not easy to achieve, but if you do not have another full-time job and you're, the majority of your working hours, and you have to have a minimum of 750 hours a year, but once you cross that threshold, you can be considered a real estate professional. And guess what? That allows you to use depreciation to offset any source of income whatsoever. So you no longer have that passive loss limitation, as it's called, that inability to use depreciation to its full extent. If you or your spouse are a real estate professional, you can use depreciation to offset any source of income. So I think the biggest misnomer, like we said, is limited partners, especially coming in and saying, wow, that's an amazing tax benefit over here. I'm going to get this huge K1, this huge loss, but you're not going to be able to apply it to your W-2. Now, don't get me wrong. The fact that you're getting the loss in itself and to be able to use that against your rental income is awesome, because there's almost no other investment strategy out there where you can pay little to no tax on the income you're making. So real estate does have that tax benefit in of itself, but to use cost seg to its full extent, that's where you need that real estate professional status.
Yeah, and just so to kind of reiterate from something that, a few of our investors have seen. One, you mentioned, right? Obviously, if they are a real estate professional, which is really a pretty broad umbrella. And
Yeah,
so once again, talk to your tax person, but I believe even if you're like a realtor, for example, that income could qualify you as a real estate professional. So go talk to them if you're in any real estate related type of industry.
right.
But what I've seen is, I've had couples who, one of the spouses makes a significantly higher income than the other. So maybe they're a doctor or an attorney or something. And the other one, they have a job that maybe they don't enjoy, they don't make as much income, and they can go do something real estate related. You do have to be active and have hours like Yonah mentioned, but 750 hours I think equates to like 10-ish hours a week or 12 hours a week, something like that. So it's not necessarily a 40-hour a week gig. And if you can show that to the IRS, suddenly your spouse's attorney or doctor income does become subject to those write-offs. So that's one thing I've seen.
Mhm.
Another thing, if I'm not mistaken, is that you have other passive gains within investing. So maybe certain stock gains, certain other investments that sell where you're subject to capital gains. Once again, depreciation, because it's a passive loss, could be applied to other passive gains to offset that.
Correct. No, passive gains,
Okay.
you're right, Jonathan, but I do want to interrupt there because
Yeah.
unfortunately, like stocks or bonds or other types of business investments are not considered passive, even though
Mm,
we consider them passive, right? It's very
yeah.
passive. You put some money in the stock market, like you're not doing anything.
Right.
Unfortunately, the IRS doesn't consider it that way. However, you are correct in that passive gains which you would have capital gains from the sale of real estate, which again is that passive income,
Mm.
would be able to offset that. So your example at the beginning of this conversation was the perfect example of that. You had these capital gains from the
Yep.
sale of real estate, presumably, and you're going to be hit with that tax. You were able to use that the cost seg to offset that. So that's another powerful way. You're absolutely right. And as I mentioned before, you're getting those losses. You're going to be able to offset the gains or the income from real estate, but also upon the sale of real estate, you'll be able to offset the gain from that as well. So it really does help you to do the cost seg, even if you're not a real estate professional.
I hope you're enjoying the content of this episode. I want to take a quick 15-second break to thank our sponsor for this episode, which is Apogee Capital. Now, Apogee Capital is our private equity firm that we allow investors to participate in large-scale multifamily investment opportunities through. If you're interested in being a passive investor and would like to learn more, you can find information on our website, www.apogee.com. Link is in the show notes. Now, thanks and enjoy the rest of the episode. Absolutely, and like Yonah said, like the situation I mentioned in the beginning was specific to sell of a piece of real estate, right? And then just
Right.
buying another piece of real estate had nothing to do with being a real estate professional in that situation. What if you have someone, Yona, who they invest in a piece of real estate, perhaps one of our syndication deals, they get this write off. Obviously, with the deductions, they're not going to pay on distributions or income that they have on the investment during the whole time. But then they go and we sell the investment 4 or 5 years down the road. We make a nice profit. And for whatever reason, they either are not able to or not interested in investing in another deal. Like I mentioned in my example, is cost seg still a benefit to them long term? And if so, how so?
Yeah, it's still going to be benefit long term, and the reason is I mean you're alluding to that there is something called depreciation recapture tax when you sell a property, any property, regardless of whether you do cost seg or not, you're going to be hit with this. It's considered like a capital gain. It's an unrealized gain, but basically any amount of depreciation that you took during the life of ownership, you're going to be subject to a tax on that depreciation. So you're not
Mm,
paying it back. That's not what recapture means. Another misnomer there. Recapture doesn't mean you're paying back depreciation. It just means you're going to be subject to that tax. Now, being subject to a tax is not the same as paying the tax because, as you mentioned, in your example, if you have another property you're investing in, you may be able to use the losses from new property to offset the gain or the recapture from the sale of the first one, etc. There are a lot of other strategies to be used there, but let's take your question and just what happens if a person doesn't want to go forward. Like that's it. They
right.
made this one investment. They're doing that. Yes, they are going to be hit with that tax on the sale. However, it's still going to be beneficial for them in the long term for a few reasons. One, most notably, is you have what we call the time value of money. Okay, time value of
Mm,
money means that the amount of money that you saved or didn't pay in taxes during that time period, right? You can use that to reinvest or you can use that to do whatever you want with. I mean, the real value of the time value of money is reinvesting and the compound interest that you can gain from not paying taxes. So you have that value. You also have the fact that the tax rate that the recapture
mm,
tax is at is always going to be lower than your normal ordinary income tax rate. So you do have that arbitrage. You have that that space between what you would have paid in tax had you not done the cost seg in the first place versus having that recapture tax down the road. So you're always going to be paying a lower tax rate. So that's the second reason. The third thing is you may actually have, especially if you're not a real estate professional, you may have like this bank of losses that you never used because if you invest in a deal and you get this huge, loss that you can't use, it doesn't go away. You don't lose it. It basically sits there on your tax return as a negative, as a loss. And then when the property gets sold, those losses can be used to offset the gain. And so
mm.
even if you didn't use those losses, right, you're not losing out. You're actually benefiting from it because you did the cost seg or the syndication did the cost seg. You can actually use those losses to offset the gain. Now, obviously, there are cases where a person's still going to be hit with a tax bill, even with all that. But again, it's going to be lower than had they not done the cost seg. So don't get me wrong. You do have to plan for it. You should consider it. However, just know there are strategies and there are ways to either reduce, defer or completely eliminate that recapture tax. We mentioned a couple, but there's the 1031 exchange, or there's opportunity zones, other things you can get into on other episodes. But these are ways that we can either reduce, defer, or completely eliminate our recapture tax on the sale.
Very helpful. And I would say if you're a listener on this podcast and you're a passive investor, maybe in one of our deals or someone else's deal, if you understand everything we've said to this point, you're far ahead of most investors because typically, a limited partner will get their K1, which is their tax document at the end of the year, and it'll have a large negative number, and that's their write-off, and the CPA takes care of everything else. So you don't necessarily have to per se be an expert on all this, but definitely understanding the why behind it helps you to ask the right questions to your tax professional and put you in the best situation possible. Yonah, let's say, obviously, our podcast is a little bit more from like the syndication space because that's what we do. But, there could be someone out there listening and maybe they own some, small multifamily personally and, or, say they own a duplex, a fourplex, or, even a commercial piece. Is cost seg, could it still be beneficial to them as an individual owner? And if so, kind of break that down for us at what point it becomes worth the money and effort spent to do the study.
Absolutely. Costing, like as I mentioned earlier, can be done on any type of property. So even if you own a single family as a rental, now you can do a
Mm,
cost seg. However, to your question, at what point does it become beneficial? So there's really two points to that question. Number one is the property itself, and number two, the individual. We talked about the individual. If you're a real estate professional or your spouse is, then doing cost seg is worth it regardless, almost on any type of property, no matter what. However, the on the first part of the question of what the property size or the property deal, typically, even if it's a single family or whatever, any type of property, over $200,000 purchase price is really where it starts to make sense. Okay. Lower than that.
mm,
And that's probably a much lower threshold than you even thought. A lot of people think,
yeah.
oh, it's got to be like a 500 or $1 million, property for it to make sense. No. Um, $200,000. That's usually my rule of thumb. Even on smaller properties or lower value properties, it can be beneficial, but I typically don't recommend it. We always run as you know, like a free upfront estimate, so you can know ahead of time what it would look like if you did a cost seg. So it's worthwhile to reach out regardless. But like I said, 200,000. That's my kind of rule of thumb. However, I will mention another incredible um, I call it a loophole, but it's really just an exception to the rule that we talked about earlier about the passive losses. Okay, we mentioned
Mm,
if unless you're a real estate professional, you cannot use those passive losses to offset your W-2 or your spouse's income. There's another exception to that rule. The exception to the rule is what I call the short-term rental loophole.
mm.
Okay, the short-term rental, and you can Google this. It's out there. I mean, it's already famous now. I have literally hundreds of clients that use this method. And what this says is that if you own a short-term rental, right, Airbnb has become much more popular over the past decade or so, and you self-manage it. Okay, that's an important part of it. There are rules regarding this, what's called material participation. You have to spend a minimum of 100 hours a year, which is much less threshold than the 750-hour real estate professional status. It's 100 hours plus more time than any other individual. But essentially, if you own an Airbnb and you self-manage it, you cross this like 99.9% of the time. Now, once you do that, you do a costing on that property, you can use the losses to offset your W-2 income. Okay, so this is
Mm.
a huge exception to the rule. And I've seen a lot of people who are involved in real estate in some way or another and get into short term rentals, and it basically changes the game because they're able to pay less taxes because of this than if they were working full time and because it's the ability to offset their W-2. So, um, that's another example. But yeah, as you said, any type of property whatsoever, it doesn't matter. Limited partner, right? General partner, even if you have some rental properties, it's still worthwhile.
So I'm an individual and I mean, just there's another hypothetical, situation, but I'm an individual with a W-2. I make 150,000 a year. So I give a third of that to the IRS each year, right? So 50K goes to Uncle Sam. I go buy a short-term rental and maybe I put 50,000 to purchase that for the down payment of it. It's a $250,000 property as an example.
Mhm.
I go get a write-off on this, and I don't know exactly how the short-term rental ones would shake out, but I can tell you a lot of our multifamily now with the 100% depreciation are well north of 50% write-offs. And so, suddenly I have a $125,000 write off, right? Against my maybe even 150 if I'm lucky, right? Against my 150K salary, and I don't pay that 50K to the IRS, right? So basically my tax savings paid for the property in year one in that example. Is that like a far-fetched idea, or is that similar to what you've seen with a lot of clients?
No, you're absolutely right. I mean, very high level. Obviously, the numbers are subject to each individual case, but you're absolutely right. That is the strategy, and like I said, I've helped hundreds of people use this exact strategy to do that. To even if they're working full time, it's not too difficult to self manage. It sounds really difficult. It sounds impossible, but there are a lot of courses out there and strategies to be able to do this. And like I said, I know literally hundreds of people that have use this strategy while working full time and able to pay little to no income tax and scale. And that's the beauty of it. Like you said, the tax savings themselves pays for the property. And if you can do that and buy one, a new property every single year, after a couple of years, 2, 3 years, you may actually be making more money from the income plus the tax savings than after taxes than you were at your W-2 in the first place. So you can literally retire and
Yeah.
be making more money after taxes, working a couple hours a week, just managing your short-term rentals, which is it's mind-boggling. But if you put your mind to it and you want to do it, and it's for you, right? Managing it's not for everyone. That's for certain. Like
Yeah.
I personally, I tried it out. It wasn't for me. I tried out a lot of different things in the real estate world and realized it's not really for me. Like I could do it, but I don't really enjoy it too much. So yes, like it's about what do you enjoy and what are you willing to sacrifice to get meet your goals. And every individual is different.
I like that you mentioned that though, because there's really two main groups of people that we speak to at Apogee. Most people that we get on a call with, they're interested in investing in real estate. Like they understand
Mhm.
the potential, they understand what it can do for them. The question is just, do they want to be more active or passive?
Right.
And some people are like, look, I want the benefits, but I don't want to do the work. And I'm willing to give up some of the return I could go get for myself if someone else does the work for me. Well, that's where investing in a syndication with a good sponsor might be to your benefit. And other people are like, I like to be in control. I want to be the decision maker. I want to call the shots. And I think that's where, like, a short term rental strategy, like Yonah mentioned, might be better suited for you. And, there's obviously a lot of people that do both as well. But it's nice that there's an avenue there to benefit from cost seg write offs either direction that you go.
For sure.
Well, cool, Yona. I want to pivot just for the last couple minutes of our conversation here. I think we've given people a lot of great info on cost seg, but there's one other thing I want to touch on because I've learned a lot from you about this, and that is on networking and particularly online with social media, LinkedIn. In my mind, you're kind of the OG of LinkedIn networking, and from someone who came to the commercial real estate world from an engineering background where networking is not a thing at all. It was a whole new world to me. And having someone like yourself that, just provide a lot of value up front in terms of teaching people how to network and, connect, make good relationships, it was really useful. And so I know this is going to be a little bit of an open-ended question or maybe ambiguous, but can you just give us some thoughts on like some of your tips of wisdom, if you will, on networking online? Obviously, you and I prefer LinkedIn, but networking with people in the commercial real estate space and developing those relationships in a beneficial way.
It's a really important question. I think a lot of people overlook the power of social media because it's like not for them, or they just don't know what to do. It's kind of, especially if you're, a Gen Z, like it's just a little bit, it's like out there. And for me, just to give my own personal anecdote, like I had zero social media presence 10 years
Mm.
ago, right? And I had a LinkedIn profile because that's what everyone did, and I basically went on it like once every 6 months or something just to like check. But what I came to realize when I got into the contact space, I was doing some cold calling and I was like researching people. And when I would do a Google search on someone's name, just to see, oh, is this the right person I'm about to call? 99% of the time, LinkedIn was the first result on Google of that person's name. And so I was easily able to verify this is the correct person I'm trying to reach out to, right? They're in the same city, same company name. And what happened was like, I was like, okay, let's check LinkedIn. And then I was like, wait a second, why does LinkedIn keep coming up? And I looked on and I saw, and this was about, like I said, about 8 years ago or so, when shortly after Microsoft bought LinkedIn, and it became like almost a rival to Facebook, where it went pivoted from becoming like this place to play, put your resume and get a job, to becoming more of a social media, but a professional social media networking platform. And that drew me into it because I wasn't into social media. I didn't really like care for it so much, but here was a place to network professionally, and it was 24/7. And it was, you could meet people and connect with people all over the world, basically. And if you pick the right kind of forum, you can get yourself out there and put yourself out there, establish a brand. And this is where, I'm talking, throwing a lot of buzzwords out there, but I at that time I came across people like Gary Vaynerchuk and Grant Cardone. And whether you like them or not, the what cannot be denied is their strategies of sales, of networking, of marketing, of branding. And I learned from that. I soaked it all up, and I just started posting regularly. And I got involved very early on with like this challenge. It was like this 30-day LinkedIn posting challenge, and it kind of educated you about how to, what to post and how to post, and different types of content and what works and what doesn't work. And by the way, that changes constantly, and even today, it's very different than it was, a few years ago. And
Yeah.
so it's constantly evolving. But what hasn't changed is the ability to connect with real people and begin relationships. Because what real estate is, and like every industry, but commercial real estate specifically, it's a relationship business. It's all about people, and it's about trust, and it's about connections and collaboration, whether it be through partners, through investors, through vendors, all kinds of different people out there in the industry. But in the end of the day, it's about people. And the way that you gain that trust is, the best way, in my opinion, nowadays at scale for sure, is through social media. I mean, you can do it with a podcast, right? I don't know how many people
Yeah.
you have listening to this. I mean, I have a podcast as well. I have no idea how many people actually listen to it, but it's a great way to kind of get your voice out there, and it's a great way to create content as well. But LinkedIn specifically, because it's a professional networking platform, I've connected with thousands of people, and when you meet them in person after, right, you go to a conference, you go to an event, it's like you already know them. And that's what
Mm.
is the most powerful thing to me, because in the end of the day, it's about that personal connection. It's about building that relationship. And it grows. It's grown my business. I can say, personally, it definitely affected us in a huge way. And I feel very strongly that everyone should be using it. There are people that use it nowadays with AI and bots and all kinds of stuff, and it's really inauthentic in my opinion. But if you use it the right way, it's still extremely powerful.
Yeah, that's a great summary. And just to kind of give the listeners my personal perspective on it, one of the things I didn't like about commercial real estate, or a perception I had coming into the business, was like everyone is real salesy or trying to pitch you something.
Mm.
And there's definitely plenty of that goes on. And so I thought, man, if I'm going to be successful in this business, like that's who I have to become. And that just, it doesn't align with my strengths or my values, either one. And when I met Yonah through LinkedIn and some of the challenges, I met someone who I've literally never ever heard Yonah pitch cost seg through Madison Specs. Like, hey Jonathan, you should do a cost seg with us, right? Um, but yet everyone goes to Yonah for their cost segs, right? And it's just because he brings a tremendous amount of value first, to where it's just a no brainer. Like, obviously, I'm going to go there. Why do I care if I can save $500 on my cost seg somewhere else? Because I probably can if I tried, right? I want someone that's going to be on my team when I need help. And so,
Yeah.
yeah, really appreciate that. And, it's something that's, worked well for me on our business as well, is just bringing value to people and being authentic to build those relationships. Well, cool, everyone. I want to be respectful of Yonah's time and everyone listening. Yonah, you've brought a ton of value to listeners today. Any final words or things that you want to leave for the audience before we sign off?
Well, I want to thank you personally. This has been a lot of fun. I appreciate you. Appreciate the connection we've had over the years. Unfortunately, I think we missed each other the last time I was in Texas, but probably coming out again pretty soon. And I do want to just mention to our listeners that you're listening to this podcast, you're on the right path because education is really the key, right? You may not have even heard of COSEG before this podcast, but now you have one more tool in your toolbox, and there are dozens of others like this. And so continue educating yourself, continue learning, and you'll go very far.
Really appreciate it. If listeners want to connect with you, Yonah, and reach out to you, where's the best place to do that?
You can find me on LinkedIn. As we mentioned, I'm on pretty much all the other social platforms as well. But do me a favor, don't just hit that connect or hit that follow button. Take 10 seconds and write a little note. Let me know that you found me on this podcast, and we'll connect that way.
Awesome. Yonah, again, just really appreciate your time. You've brought a lot of value to the listeners today, and myself. I always learn something new every time I'm speaking with you, and really appreciate that. So thanks for taking the time today.
My pleasure. Thanks so much.
Awesome. And for listeners, we'll see you on the next week's episode of the Apogee Wealth Podcast. Thanks for taking the time to listen. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.